sustainable expansion, we're looking at 3 core principles: economic sustainability, environmental sustainability, and social sustainability. Now, I don't know what you think, but that to me sounds like a lot of jargon. What does economic, social, and environmental sustainability mean? What we really want is that we can look back in 5 years' time and say that if we expanded in dairying, it was the right thing to do. It was good for us. There's a lot of things that can go wrong, and I suppose what we want to do is to, I suppose, highlight the things that can go wrong, and I suppose put plans in place to manage those risks, so that you can look back in 5 years' time, and your family will look back in 5 years and say, listen, that was the right thing to do for us. For the average dairy farmer, even if you're at the moment not thinking of expanding and you want to continue as is, there is still, I suppose, the environment that we're farming in now has changed drastically. We have this great opportunity, okay? Quotas are gone. We're very well aware that, I suppose, the most fundamental thing that's happened to the industry in 30 years. We are now selling milk all over the world. We're competing on our own grass-based system. So that's, I suppose, really positive. But there are some big challenges ahead. And I suppose particularly for anyone that is taking on expansion. There is significant investment. And with investment, okay, there'll be debt taken on farms, and that'll pose risk. Okay? We also, I suppose, have the big thing that we're going to have to deal with is volatility. And 2015, I suppose, and 14 have shown us a good example of how volatile it is. We have a graph here that really shows, I suppose, how things changed so drastically in about 2007, 2008, when we got totally exposed to world markets. And what's shown here is actually not just milk price, but the inputs of feed and fertilizer. Everything started moving around very drastically. And that makes it more challenging. That's a new challenge that we have to deal with. And when we take on investment and expand, it's going to be even more difficult to deal with it. I suppose the other thing, and this is one of the big focuses of today, is that to manage a business post-quotas, you will require new skills that you didn't need during the quota period. And that's to manage an expanded business. And those skills are primarily around financial management, planning the business, projecting forward. In the quota era, we did more or less the same thing every year. And we could look back and say, how did last year go? And based on what happened last year, we could do a plan for next year. But it's going to be very different now, because there's going to be, milk price is going to be going up and down, the levels of debt on farms is going to change, and we're going to have to deal with, I suppose, the old traditional volatile things like the weather. Okay? So I suppose they're the risks, they're the things that can go wrong. What can we do about it? And I suppose the first key thing we need to do is to plan. Okay? If you're going to expand, you need to have a plan. If you don't have a plan, just don't consider expansion. And what do we mean by plan? And I suppose the first thing in the plan is you need to have a goal. Okay? Not even Henry Shefflin can score if he doesn't know where the goalposts are. Okay? You need to know where the goalposts are, and that's goals for your business and goals for your family. Where do you want to get to? That's the first part of the plan. The second thing is then, look where you are at the moment. If you're not in the top 20% in terms of efficiency, you shouldn't be considering expansion, because you get a lot better return by focusing on efficiency first. Okay? Efficiency first, then look at expansion. Once you have that sorted out, the next part of the plan is figure out what resources you need, how much land, how much capital you'll require, how much extra stock, what's the potential of your farm. And we'll talk a little later about stocking rate and what the potential of farms are. Okay? And once you've figured out the resources, the next part in is to look at the capital. How much capital will it take, and can you pay that back? And I suppose that's really the important bit in terms of looking at your financial projections. As I said, in the past, it was easy enough. We looked at last year, saw what happened. But in the future, we're going to have to be able to predict forward. Okay? Predict what the impact of the volatile milk price is going to have on the business. Predict how the farm is going to change. And you're going to have to factor in that as you expand, you're going to have lower animal performance. You're going to be taking on more hired labour. So you're not going to get the same level of performance that you might have got in the past. And that's something you have to factor in. There are things you can build in, some safety risks that you can build into your plan, like a contingency fund for doing the expansion. As I said, budget on lower performance. You stress the plan with different milk prices. Okay? We don't know what the milk price is going to be any one year, I suppose, but what we do know is where to the range that it can move within. And we've seen that over the last few years, the type of range of milk price, and stress tested, can your business survive if we hit a bad milk price year again, combined with bad weather? And I suppose the last one, and not one to forget, is the whole area of the workload, right? Dairy farming, I suppose it's seasonal in Ireland, the spring calving system. There is a massive extra work required, and that's going to be dealt with in detail at the next board and how to cope with that. As I said, one of the things we mentioned was efficiency, and a lot of people now are talking about, when they're looking at debt, how much debt can you take on per cow, right? I suppose we want to make one point that is totally dependent on the farm and the levels of efficiency that you have. This is just two farms, one that's running at an average level of efficiency. These are 40, 100 acre dairy farm, milking about 100 cows, one managed with average levels of efficiency, one running at the top 10% in terms of efficiency. And if you look at what's left over after paying for all the costs plus allowing for drawings, here to fund tax and debt or reinvestment, you have 20,000 versus 55,000. So you can't say that there's a single figure that you can use as what's the appropriate level of debt per cow. Certain farmers can cope with a lot more depending on the efficiency of the business. Sorry. The last thing I want to deal with is, I suppose, the technologies around expansion. There is one very easy way to expand. Okay? It doesn't require any capital. All you have to do is ring up the feed mill, order another load of ration, and within a couple of days you'll be selling more milk and you'll have expanded your business. Okay? It's very simple, very low risk job. There's one problem though. There's no money in it for you. Okay? This is just an analysis we done on a bunch of farmers. That last year there were 70 farmers involved. They were on pasture base, right? So these farmers measured grass every week. Okay? So they were good grazing managers. Remember last year we had a high milk price and a relatively low grain price. Okay? We looked at what was the impact for every extra ton of feed they brought onto farms. And in 2014, they lost money. So these were good grassland managers with a high milk price and a low feed price. And for every extra ton of feed they brought in, their overall farm profitability went down. Okay? What is the impact? And I said this, we see, is the two key drivers of profitability post-calving or post-quotas. And this is what you're going to, I suppose, a lot of today is going to focus on, the third and fourth board in particular. Okay? Tons of grass utilised per hectare. Okay? I suppose it's a complicated enough thing to understand in some ways, is how you increase tons of grass utilised, but it's driven by getting the stocking rate right, getting the long grazing season, growing the grass and utilising it. There's a full board dealing with it above there. But that is the key driver of profitability. A key driver of cost control post-quotas is the 6-week calving rate. And I suppose the figures are there showing what impact that they make on the business. Okay? Milk yield per cow. There's a lot of people going to come into your yard over the next couple of years trying to sell you something that will increase the milk yield of your cows, particularly if the milk price rises. It has absolutely no relationship to profit. There is no relationship whatsoever between milk yield per cow and profitability. The two key drivers that will drive profit post-quotas in our type of systems is the amount of grass utilised and the 6-week calving rate. Okay? As I say, there's going to be a number of boards that are going to deal with how you can improve all of those. So to summarise, ladies and gentlemen, to put it all together, right? If you don't have a plan, don't consider expansion. Okay? Plan first, expand afterward. Focus on efficiency first, and focus on those two key drivers that will make the farm more profitable. That's grass utilised per hectare and the 6-week calving rate. Okay, ladies and gentlemen, you're the first here this morning, so you're obviously very eager. Do you have any questions? Any comments? Any of you want to disagree with me? You're all happy you can grow and utilise more grass and...
That information startle you when you researched it?
Okay, so I suppose the question was, did this information surprise us when we first researched it? I suppose the first thing, we always knew that grass utilised was a key driver of profitability. 2014 we had a high milk price. What we're seeing is that figure is increasing all of the time. It's becoming a higher proportion. It's accounting for a higher proportion of the variation all of the time as we move to, better grazing management. I suppose this one actually did surprise us, that in 2014, when we had a high milk price, a low grain price, that we saw that when we fed a ton of concentrates, we increased milk sales by about €450, we were increasing costs by more than twice the cost of the concentrates, which is surprising. Like the cost, you assume, like if you get a response, and people do very simple sums and assume they get a response of 0.67, 0.8 to 1 response to concentrates, so that will pay for the concentrates. But what happens is when you move into those higher concentrate systems, and we've seen very good examples of this all over the world, where they move into the higher concentrate systems, higher input systems, not just do the cost of the feed goes up, but all the other costs get dragged up with it. And when the milk price goes down, it's very hard to pull those back out. Yep. So I suppose the question is, if we go into higher stocking rate systems, they have to increase the feed. And I suppose what we're saying is you have to match the stocking rate to the ability of the farm to grow grass. And that, I suppose, is one of the key drivers. Like, what we're really trying to make, I suppose, point we're trying to make between these two, this part of the board is that driving up stocking rate makes sense if you're utilising more grass, if more of that extra milk that you're producing is coming from grass. If increasing stocking rate allows you to utilise more grass, it will be profitable. If you drive up stocking rate and all you're doing is bringing in feed from outside or bringing in concentrate, it's not going to be profitable, particularly on low milk price years. And as I said, once you get into that system of bringing in the feed, when milk price goes down, it's very hard to get out of it and pull back down the cost.